This is Capital Success by Chris Shepley, a series where we talk about all things day trading, the world of investing, and how to play the game of capital success. I hope you find value in this. The psychology of a successful investor. So, when we look at what makes a successful investor, we typically refer to two key things, analysis and psychology. Whilst at times they sort of do go hand in hand, a greater aspect of being successful is knowing how to navigate your own psychological barriers and, in essence, the psychological barriers of those millions of other traders whom you're ultimately battling against every single day in the market. When we're talking about the psychology in trading, eliminating the aspect of technical for the meantime, we're talking about the aspects of knowing risk analysis, risk awareness, fear of missing out, greed, knowing when to quit, knowing when to stop, all of these little aspects that make up the personality of a trader. And now, you're not going to know these from day one, and I'm going to share a story as well quickly here, that when I very first got into trading, I started in Forex and went straight to crypto back in 2020, 2021, around that area. And I was looking at your Ethereums, your Litecoins and all that. And in my mind, I'm thinking about, I'm young, high risk, high reward. I want to go for it. So what I did was I went on TikTok and YouTube at the time. And I actually found a project that, I won't say the name of it. I found a project that looked quite good. It was a meme coin at the time. And I thought, yeah, right, I'll jump in this. It was very early days, as in it's been out for, I think it was 3 days prior to me seeing that video. And I actually tucked in, I think it was $200, Australian, that is. And overnight, that 200 went to 300. So then I chucked in another 350, I think it was, making my total 550, not including those profits that were already there. And that turned into about $1,400 the next night. So I think I finally put in a couple of $100 more. And within a week and a half, I had turned approximately $550, maybe $600, into about 60,000 Australian dollars. Now that was insane. I had never even come close in my investing career. I was only young at the time. I had never come close to earning $60,000 off a $600 trade. That's a ridiculous return on investment. But the psychology of trading, I didn't quite know how to navigate the trading world, the day trading world, the investor world. I was still learning. I'd made trades in the past before that, but this was my first insane trade. So what I did was I looked at the figure. I thought 60,000. I was almost numb to it. I thought it's going up so quickly. It's not going to stop anytime soon. And then the next day, I think I went from 60 to 62. It had slowed down a little bit. Then the next day I went to 57. And I looked at it and thought, it's okay. It'll go back up. Next day it was 53. The next couple of hours was 45. I remember looking at it. I thought, do I hold? Do I sell? I held. About a month total, so about 2 weeks after that, it had gone from equivalent of 600 to 60,000 down to about 10,000. Now, I could have banked 60,000, but I didn't. What I did was I didn't have a risk analysis. I didn't have a strategy. I had fear of missing out. I had a bit of greed, and that was my first ever big trade. So I actually lost $55,000 because I sold a couple of $1,000. I actually lost $55,000 in that trade. Now that was a big life lesson. I had to go out of that a bit cut, a bit annoyed, a bit all of that with myself, but I learned something. I learned how to evoke risk analysis. And going in further into trading, my trading career, I learned how to set stop losses, how to strategically enter and exit markets, how to read chart patterns, all of that. And my psychology personality as a trader, as an investor, got so much stronger. And I'm now I think about 6+ years on from that, but I'm 7.5, close to 8 years of trading now. And that just seems... It was an expensive lesson at the time, but these days, it was actually the cheapest lesson I've ever had because it showed me how to be a good investor. So psychology was a massive aspect of becoming who I am today as a trader because I never knew how my greed and fear of missing out could result in actually losing so much money. So there was an element of emotional analysis in that. I had to sort of personally identify, all right, where do I strategically cut out? Even if it goes up an additional 10-15% of where I'm prepared to sell, am I losing that? Or is that just a potential gain that I just didn't get for? Because you have to really change perception of trading. you're either going to miss out on an additional 10%, or you wait too long and it drops 10%. What would you rather? Would you rather miss a potential or lose a guaranteed? So it's about changing the psychology, the traits of a successful investor, to identify that it's not always about seeking the absolute maximum profit you can, but rather waiting till analysis, and this is where technical analysis also comes in. It's about identifying where analysis starts to slow down and you realize, okay, this is the sticking point. It's probably time to sell. It could go up, but it's time to sell. It's about understanding risk awareness. And that is almost the precipice of the psychology of a successful trader / investor, is knowing when to stop. That's probably the biggest one of all. But ultimately, there's 4 factors that make up a successful trader. So there's the art of patience, zero emotion when trading, risk tolerance, and balancing optimism with reality. So the first one we'll talk about is patience. So as a trader, you're not going to, like the scenario I just said prior, that's not going to happen for 99% of people. And even if it does happen, it's very, very rare. It might only happen once to ever, unless you're playing with very large capital. So when we talk about patience, it's about identifying that technical analysis and psychology when trading go hand in hand. But if you know how to read technical analysis, so identify chart patterns, flag, bull, bear, all those different analysis patterns that you can have, you'll soon learn that it doesn't happen overnight that a chart is going to go from 0 to 100. Forex is a great learning opportunity for that, because it's a multi-trillion dollar industry. It's not volatile relative to crypto. Crypto is just insane with volatility. But Forex is a great example of where you will have the technical analysis opportunities to learn. You'll see the different patterns forming, but you won't just have it drop out in front of you. So it's a perfect opportunity to learn patience. And with that, of course, because there is less volatility, the ability to be patient in those long and short trades is paramount. So when it comes to making a massive trade, you see that, all right, in 2 weeks' time, X is going to happen. I'm pretty confident that the market's going to move in this direction. That means that you're going to have to obviously wait 2 weeks. And within that 2 weeks, if an event, a major life event is going to happen, let's say a different presidency or a company is about to consolidate or rather liquidate, whatever it may be, it's about identifying the market trends and knowing that, all right, this is going to happen. When's the best buy-in opportunity, or rather the best sell opportunity if you're already holding shares? So it's about identifying patience when trading and knowing that you don't have to make a trade straight away. You can identify, you can wait, and you can seek clarification in the charts. So for example, when you're looking at an ascending wedge, for example, how many times does the candlestick check the support and resistance line? Did it check it once? Did it check it twice? Did it check it 3 times? Typically, 3 checks and confirmations means that you're on the right track. But rather, if you just draw a line and it checks it once, you don't have absolute confirmation. You might have a tiny amount, but it's not as good as 2 and it's not as good as 3. So it's about having patience before making a trade, knowing that, all right, I'm going into this trade with the greatest opportunity to make money because I've done the most analysis I can possibly do. The next factor we talked about is zero emotion. And this one majorly refers to crypto and stocks as well, but mainly crypto, where if you hold a specific project that you're really passionate about, maybe let's say your friend made a small project, or if it's on a bigger scale, for example, there's a project that you've come attached to and you really want it to succeed, that instantly is drawing a sense of emotion and subjectivity into your trade. So what that means is that you'll be blinded for when a chart might be starting to fall. You'll be blinded, similar to how I was, in saying that, no, it's all right, it's going to go back up. That allows emotion to enter your trading personality, and inevitably you will lose out in the long run. So it's about learning from day one, if possible, but at least enact it now, that have zero emotion in absolutely everything you trade, because not everything is going to be successful. And you think of the massive companies in the world that were successful 20, 30 years ago, 99% of them don't exist today. We talk about Bitcoin, for example, has done tremendously. But then we look at things like Ethereum and Solana, which were 2 and 3, and in this case now Solana's dropped off a little bit, where they haven't quite performed as well as Bitcoin has. But people who weren't on the Bitcoin train, were on the Ethereum and Solana train, were still catering towards them and still advertising them, saying these are the best projects to be in. Yet you statistically, you look at what has occurred over the past 1 year, 3 years, 5 years, 8 years even, they just haven't grown at the same rate. And if you were someone who was attached to those projects over another, you've potentially lost out on opportunity purely because you were emotionally attached to a project wanting to do well. So it's about learning as an investor. How do you completely eliminate emotion through trades? And quite simply, you do it by not getting attached to one project. If something you loved started to fall, sell, move on. It's not associated with you. It's not going to care about your feelings. It's going to do whatever the market says it's going to do. And the market is controlled by the majority of the world. So you got to think, does the majority of the world care about what I care about? Probably not. You are all individuals. So eliminate emotion immediately. The third one is risk tolerance. So it's about setting stop losses. It's about knowing what you're prepared to lose if you're prepared to lose. And it starts ultimately at the absolute beginning when it comes to setting capital. So how much capital are you going to invest in the markets? How much are you typically prepared to lose? Because you should never invest in the market anything that you're not prepared to lose. So yeah, once you identify what balance you're prepared to go in with, now it's about identifying your stop losses and your diversification of what you're going to invest in. So again, we'll refer to the cryptocurrency or stocks as the best two examples here because you can easily diversify between both of those. So let's say 50% of our portfolio is in stocks and crypto. So 50% is in Microsoft, Tesla, we'll go Telstra, we'll go Apple, we'll go the big businesses. They're all slightly diverse in what they have. So Tesla is for cars, Microsoft is for software, Apple is typically for hardware devices, phones, etc. You have slightly diversified between what you've invested in. So if the automobile industry, for some reason, fails, you're still in the technological industry and vice versa. And then when you go to the crypto industry, there's all different areas that you can invest in, such as gamify, virtual reality, meme, high yield. There's all these different industries within that you can diversify in. So there's a true opportunity between separating your portfolio between different diversification of asset classes, but also different diversification of industries within that asset class. So setting a risk tolerance to one specific industry is a pretty massive deal when it comes to a successful investor. But not only that, it's also within each individual trade, it's about setting stop losses and risk tolerance. So what that really means is when you're reviewing a graph, and this refers back to a bit of technical analysis and psychology, you need to know when to set stop losses. So what that means is that, let's say you buy in at exactly $25 and you set a stop loss of $24, for example. So what that does is if the price goes $24 or below, your auto stop loss kicks in and you auto sell. Yes, you make a loss of $1 times however many shares you purchased, but you have a safety net in the essence of if that were to have fallen to $20, you wouldn't have lost $5 per share. Instead, you only lost $1 per share and you've mitigated the loss. And that's a massive deal when it comes to a day trader investor because there's times rather that either you won't be sitting at your computer or your phone, or you won't have access to make a trade, or something abrupt might happen in the market, the industry, and your share prices just plummet instantly. Having those stop losses in place is a massive safety net, and it's also an asset of a psychological barrier because a lot of people don't want to set these, well, if it falls for like 5 seconds, I'm going to lose my money, I'm going to lose my trade. It's a psychological barrier to overcome, knowing that some people might feel that, of course, it might happen where the stock might have gone from 25 to 23, your stop loss was 24, but then it went back up to 32. And that might be a failed trade in your eyes, but realistically, it was a safety net to ensure that what happens if it went further? Maybe I lost out on money, sure, absolutely, but you would rather miss an opportunity than be involved in a failure. That's something to remember. The last factor that comes with a successful day trader investor is balancing optimism with reality. And what that means is, and again, it goes back to my story, you're not going to make $1 million overnight. You're not going to find a trade and ride it to the moon. It's going to consolidate. up and downs, bumps are going to occur along the way. It's not just a one-way ticket to $1 million. You're going to have these events where, again, you're battling with other investors and the psychology of them individuals, people who hold larger portfolios than you, specifically in that project you're in. Let's talk about XRP, for example. If there's a massive whale in the industry and you're holding XRP, they're holding XRP, and they sell before you, the price is most likely going to plummet a little bit. And they got the better price over you, but more importantly, if other people, again, there's millions of people in the market, get fearful of that price going down and they sell theirs to not lose out on profits, market one by one plummets down, and it's called a consolidation event. And they occur, they go up and down, it's completely normal, but there are times where, and I talk about crypto being 50-50 between technical and emotional, it's about knowing when emotional is taking over. And that is a massive psychological asset as a investor and a day trader should have. It's a skill rather, that it's about identifying the technical analysis is correct, trusting yourself, but the market is falling because of an emotional event. And typically with emotional events, the market falls, it goes straight back up because the technicals support the price where it was at the previous moment in time. Whereas if it was on the flip and your technicals were starting to fail and fall, but the emotional side, i.e. the social media, the people talking online saying it's such a good project, etc., that goes to them having an emotional attachment to that project. But you know how to read technical analysis. You've identified that, hang on, the market's actually going to fall here, so I want to sell regardless of everybody around me saying I should stay in. So you sell at the highest price and bang, the technicals fall. Most people lose out on money, they become exit liquidity, but you've trusted yourself against all psychology of other people in the market and you got the highest price. So ultimately it's about balancing optimism with reality, trusting yourself, knowing your own technical analysis ability, trust your own outcomes before you read and understand and allow the insights of emotional other traders out there. Because if you trade based on other people's emotional suggestions, most likely you will lose money. So with that in mind, these are the common psychological pitfalls to avoid, and I'm just going to fast track these. So fear of missing out. That majorly goes to the trader who, let's say, have made a decent profit but don't want to cash out yet, and they haven't set a stop loss, and the price is slowly consolidating. Their fear is that, I don't want to sell now because it could go higher, but they hold on to that emotional side of their trade, their investment, and the price slowly falls, and then they lose it all. I had that in the beginning. Most investors have that in the beginning. If you cut that from your personality as a trader, you'll find that you're a lot more successful than the other typical person in the market with you. The next pitfall is groupthink. Now, it's similar to what we just discussed, but it's having your trade be based on the emotional suggestions of other people. It's about not being a part of the group, but understanding the market based on your own analysis. So, in essence, that does require you to know how to read candlestick charts, patterns, etc. So you don't fall under the illusion of someone else's analysis. You know how to read it yourself. And even if someone says, here, I've done analysis, here's a photo, this is what I believe, they may also be wrong. It doesn't mean because they post a photo that they're correct. So it's about knowing how to do analysis for yourself to determine what the best investment opportunity is for you. The third one is overconfidence bias. So let's say you're on a roll. You've made 5 great trades. Let's say you're a day trader scalping the market. You've made 5 amazing trades and you're on the roll. You're ready for your 6th. You're looking at the opportunity. You're thinking, yep, I'm just going to go for it. Bang, chuck it all in, all your profits for the day. And you are overconfident. You lost all your money. So it's about not having the overconfidence thinking that I've done 5 amazing trades. I'm on a roll today. I'm just going to keep going. Sometimes it's better to cut short. Say, I've done 5 good trades today. Let's call it a day. Let's move on. And on the flip side, if you're failing 5 trades, and let's say, all right, I've made 3 bad trades. And this is actually a strategy you can do. If you make 3 failed trades, you should just stop trading for the day and take a break because you obviously haven't analyzed something correctly or you've just been completely incorrect in one essence. It's a perfect opportunity to stop trading with cash for the day and just play the charts again, replay the charts and identify where you went wrong. use those opportunities. Again, if you are trying to be a trader or an investor as a career, it's completely fine to have these days. Everyone has them, but it's about identifying, all right, where was I incorrect? What can I do next time to be better? And it's about using those failure opportunities to learn and adapt and become better as a trader. And the last pitfall is ultimately not having a trading strategy going into the day. So everyone should have a trading strategy, whether that's you want to make this amount of money over this amount of trades, you want to make this amount of trades per day, you don't want to go below this profit line, you don't want to go above this, etc., whatever it may be. Everybody has a journal that they should have that has set stipulations about what they want to achieve. This is probably one of the greatest assets a trader could have, because they have, in essence, a step-by-step map of what they want to do. If you go into a trade, just here's some money, chuck it into the trade, I'm going to buy it, I'm going to watch the charts, I'm going to sell. It works for newer traders, it doesn't work for someone trying to make a career out of it. So the biggest pitfall is assuming that what worked at the beginning is going to work throughout your career. It's not going to. You need to have a journal. So overall, what makes a successful trader based on psychology is having a winning mindset, developing the winning mindset. And you develop that through having a trading strategy journal about knowing your stop losses, how much you're prepared to trade, and how much you're willing to potentially lose, knowing when to enter and exit a market, and knowing how to trade with zero emotion. These are all the factors, the aspects that make up a successful day trader / investor, whether it's on a casual basis or a full-time career. All of these elements combined together truly make what is known as a successful trader. Now, for someone who's looking to learn how to do technical analysis or trying to better themselves as a trader, learn about what other people have in their strategies, etc., you can find this stuff on YouTube, and a lot of people do speak about their strategies, but they also allude to some pretty toxic bad habits. So it's about truly identifying what works for you and what doesn't. Now, I do offer a trading playbook that goes through absolutely everything on a beginner's level, 0 to 3 years of trading experience. And that goes through everything from technical analysis, how to read charts, all terminologies, everything to do with trading for a newer to moderate trader. It's all in this one playbook. So if you're looking for something like that, we have it. Otherwise, go on YouTube, go on Google. These days, go on ChatGPT and just learn as you go. The best thing you can do is demo account, practice, continue trading with fake money. Don't use real money to start, and learn how to assess chart, psychology, enter, exit, make a profit. Once you learn how to do this and you can start using real money, then that's where you separate yourself from being this casual part-time trader to a full-time professional trader. My name is Chris Shepley. Hope you found value in this, and again, thank you for listening.